All right, man, what a time to be alive, huh? So much going on. Especially make sure that my audio is good. Election's over. Man, the audio sounds kind of weird. Let me see the audio. Hello. All right, audio sounds good. All right, that sounds better. All right, cool. Man, all right. So, welcome to the special live stream session. And man, am I super fired up to talk about the Federal Reserve's decision today with an interest rate. Well, they're going to make a decision today with an interest rate cut in less than 30 minutes or in about 28 minutes at 11 a.m. Pacific Standard Time or 2 p.m. Eastern Standard Time. And as always, I have my favorite channel, Bloomberg, ready to go. And this is also being live streamed to in my private group. So if you're interested in joining my private group, you can visit firesitchat.com/community. And Jerome Powell is also going to have a press conference at 11:30 a.m. or 2:30 p.m. Eastern Standard Time. And that press conference is going to be spicy because there are going to be a lot of political questions. And Trump has already criticized Jerome Powell in the past. So, and besides that, we definitely want to hear what Jerome Powell has to say about today's decision to cut rates by either 25 basis points or maybe even surprise us with another 50 basis point rate cut, and how the Fed is moving forward at the next meeting on December 18th and the complete outlook of 2025 with the Trump administration taking over the White House, and how Trump imposing tariffs will have an impact on the consumer prices. And if you're watching this on replay, I'll be sure to leave chapters in this video so that you can navigate your way around the live stream. So, um, just in case you've been living under a rock or in a cave for the last few weeks, Donald Trump was elected the 47th president of the United States, and the Republicans are taking control of the Senate, and they're pretty close to taking over the House as well. And a lot of people thought the election was going to last a few more days, but it went by pretty fast with Trump dominated the swing states in Georgia, North Carolina, and Pennsylvania on Tuesday night, and I was glued to the TV as well. And let me know in the comment section down below where you're watching this from. And I'm in Las Vegas, and Nevada was one of the swing states with 6 electoral votes. So I got to see both candidates campaign in Las Vegas, probably a lot more often than usual before Election Day. And I thought Arizona and Nevada would be the deciding factors for either Trump or Harris, but the rest of the country decided that in advance before these 2 states finished counting. So I know there's a lot of going on with what Trump might do after January 20th with border security, tariffs, the cost of living, and immigration. But I want to briefly touch on the subject of tax cuts and tariffs, because the personal income tax of the Tax Cuts and Jobs Act from 2017 is set to be expired on December 31st, 2025. And now that the Republicans have control in Congress, and we'll see what happens with the House, but it looks like they are on track to take over the House by about 4, maybe about 5 seats. But anyway, and they're going to take over the Congress and the White House. And I could see the TCJA, or Tax Cuts and Jobs Act extension, or maybe even a 2.0 happening in 2025. And I don't blame you if you don't remember what was in the first original Tax Cuts and Jobs Act, or TCJA, way back in 2017, because that was almost 8 years ago. If you think about it, man, that's pretty crazy, right? But anyway, the TCJA raised the standard deduction while introducing new limits on itemized deduction. So it expanded the child tax credit, eliminated the personal exemption, and reduced our marginal tax rates. The corporate tax was also permanently reduced from 35 to 21%, but most of the changes, like our personal income tax brackets, will sunset on December 31st, 2025, if Congress does not extend TCJA provisions past 2025. And here's some things that he talked about during his campaign about taxes. So first, he mentioned lowering corporate tax from 21% to 15%. And his intent is to create more profit margins for corporations to pay their employee more or to reinvest in their companies. But the counter argument is that decreasing corporate tax even further would just end up paying their top executives millions of dollars. So going from 35% to 21% and now potentially 21 to 15% would be a significant decrease for the US corporations. Could it happen? If you asked me before the election, I would say that's possible. But now that the Republicans have swept both Congress and the White House, and it looks like almost the House of Representatives, I think this could very likely, highly likely to happen. And second, he mentioned several times during this campaign that he wanted to eliminate taxes on tips, Social Security benefits, and overtime pay, and completely eliminate the federal income tax by replacing it with tariffs to fund federal spending. Now, eliminating federal income tax is not going to be an easy task because the president of the United States cannot just sign a piece of paper and eliminate the federal income tax. It takes an act of Congress or maybe even passing a constitutional amendment to abolish income tax. It's not going to be an easy thing to do, no matter who got elected, right? And Trump's push to eliminate income taxes made it sound very appealing to a lot of people, and it got my attention too, right? But how that works, the process of it wasn't really revealed. Besides that, the tariffs would eventually take over to replace the income tax revenue. Would it really work with tariffs? Before I answer that, though, if you don't know what a tariff is, it's basically a tax on our imported goods. It's used to increase the cost of foreign-made products. And let's just say that things that are made in China or made in whatever country that have significantly lower labor and material costs, or those who allow unfair trade practices. And China is one of the countries with unfair trade practices. So what Trump wants to do is to level the playing field for US companies to compete with foreign companies, or maybe even restricting the US companies from outsourcing their labor costs to the foreign countries and allow them to use the US labor. Now, the consequence of that, that could be a topic for another day, because I don't want this video to be like over 3 hours long. And well, with the live stream, it's probably going to be about an hour and a half anyway. And tariffs are paid to the US government before foreign goods can be brought into the country. So the common argument from our economists is that China and other countries could end up raising retail prices, which could cost Americans more money to purchase them, right? So if Trump does impose tariffs on all foreign goods, like he said he would, then the short-term consequence is that those imported goods would have higher price tags. Then the U.S. consumers would have to choose between a domestic product or an imported product, or to allow domestic producers to have fair competition. Now, that's a generalized speaking, right? The long-term impact would be a reduction of foreign goods imported into the U.S., and that could be that's just one of the possibilities. If we have a supply shortage of any products because of a limited supply in the U.S., then the prices could also go up overall in the long term, right? So can tariffs completely substitute income taxes? Based on the current federal spending and budget deficit, I don't think they can completely replace $2.4 trillion in individual income tax revenue. Can tariffs, in addition to income taxes, reduce the U.S. budget deficit? That's a possibility, but I don't think it could happen right away. Trump could use tariffs as leverage to negotiate with foreign countries for fair trade, and we'll have to see how it plays out after January 20th. So, let me show you this. And the vast majority of Americans are in the lower tax brackets between 10 to 24%. And about 15% of Americans are in the 32% marginal tax rate or higher. So if you look on the right side, these were the marginal tax rates before Trump passed the Tax Cuts and Jobs Act in 2017. So 10% never changed, but 15 to 28%, up to 39.6% was pretty significant back then. And if Congress doesn't pass a new law in 2025 or extend the TCJA, these marginal tax rates will go back to the way it was before 2018. And after TCJA was passed in 2017, these marginal tax rates took effect in 2018, right here on the left-hand side at 10, 12, 22, 24, 32, 35, and 37%. If you take a look at it here, it says current marginal rates between 2018 and 2025. Our tax rates are already historically low. So in my opinion, what's more realistic is that Congress will probably end up extending the TCJA possibly, okay, with the same marginal tax rates or just making them permanent. And I could also see the Republican-controlled Congress and Trump lowering the marginal tax rates by possibly another 200 basis points or 2%. And that's just my guess. But lowering the income tax further could increase the budget deficit if they don't reduce federal spending, right? And if you guys have been watching me for a while, and I've always said that when it comes to budgeting, you have to look at your spending first, then your revenue second. I think tariffs can benefit many domestic companies that have been trying to compete with countries like China. However, the prices of goods could also increase in the long term. Can tariffs potentially make inflation go higher? Absolutely. If Congress and Trump are serious about another round of tax cuts, they will have to find that sweet spot to make sure that the federal budget doesn't make the deficit worse than it is without sacrificing too much of the revenue. That makes sense so far, right? And it'll be interesting to see how everything unfolds in the coming years. Let me know in the comment section down below what your thoughts are on tariffs and our current progressive income tax system. But what a timing for this Federal Reserve meeting, right? Is anybody else glad that the election is finally over? Let me know in the live chat if you voted on Tuesday. But anyway, there's a 99% chance that the Fed will cut rates by another 25 basis points today. And what's really conflicting is that the Fed is cutting rates, but at the same time, Jerome Powell at the last conference saying that our economy is strong. Why are we cutting rates when our economy is strong? Is it maybe because of the labor market? And that's going to be the entire focus today, besides all the political questions I'm sure Jerome Powell is going to receive with the job market, the most labor data that came out last week that's going to be another focus too. And the market is also predicting another 25. Oh, you know what? I forgot to share the screen. I'm so sorry. There we go. Now I'm sharing the screen. So, and the market is also predicting another 25 basis point rate cut on December 18th, and we can end 2024 with 4.25 to 4.5% in Fed funds rate. And we're also going to get the latest SCP or summary of economic projections for the December meeting to have a better outlook for 2025. But it's really going to depend on how the jobs data looks between now and December. And if the jobs report keeps coming in weaker than expected, then I wouldn't be surprised if the Fed keeps cutting rates by another 25 basis points, one meeting at a time. And I don't think they're going to do any emergency rate cuts because we're not seeing the unemployment rate jump as much. The Fed can continue to cut rates, and they're probably not going to stop until they reach a certain point. So don't be surprised if the Fed funds rates drop below 3% by the end of 2025. Somebody said I'm talking too fast. I'm sorry. You can slow it down on YouTube, but when I get excited, I talk pretty fast, and this is pretty exciting stuff, right? Okay, and this might be the second to last time Jerome Powell. We're going to see Jerome Powell at the podium as the chairman of the Federal Reserve because the FOMC meeting after December is going to be on January 29th, which is 9 days after Inauguration Day on January 20th. Now, that's kind of a controversial topic, but Trump already said that he wants to fire Jerome Powell when he takes office, but is he going to have enough justification to do so? I am not sure. But Jerome Powell is supposed to stay as the chairman of the Federal Reserve until his term is up in 2026. And if you guys remember the July meeting, he already said that he intends to stay as the chairman until his term expires. So we'll see if Trump will find a way to fire him or just keep him on, because it's actually pretty tough for the president of the United States to fire the chairman without a cause, since it's an independent establishment. And I'm sure he's going to be asked about it at the press conference today in less than 45 minutes. So that's going to be a juicy subject. And I wouldn't be surprised if a reporter comes out and ask him straight up, are you going to resign, comes January, or are you going to stay in until your term is up? And then we'll know, if Trump comes out on Twitter or whatever and say, you're fired, then, that would be interesting, because Jerome Powell would then be saying, well, fire me. I'm not leaving my job, So anyway, that would be an interesting drama. So let's take a look at JOLTS just real quick. The labor market is going to be one of the other focuses, one of the focuses again today. And this just came out last week from the Bureau of Labor Statistics that 7.4 million jobs were open at the end of September. And the expectation was 8 million. So it was a huge miss and came in a lot lower than what economists had predicted. The JOLTS, if you don't know what that is, that's the jobs openings and labor turnover survey, which is a lagging data to the labor market. So if you look at the bottom of this page, the number of job openings for August was revised down by 179,000 to 7.9 million, and the number of hires was revised up by 118,000 to 5.4 million, and the number of total separations was revised up by 171,000 to 5.2 million. And what's concerning is that layoffs rose 165,000 to 1.833 million. And historically speaking, okay, I mean, layoffs are still low by historical standards, but the JOLTS report is giving all of us mixed signals like the second date with someone you just met. And the hurricane strike and strikes are the Boeing strikes are likely the contributing factor, but the job openings fell to the lowest level in more than 3.5 years in September. And I'm not sure if the Fed can continue to say that our labor market is healthy. It's not trending in the right direction. And when the unemployment rate came out last Friday, I had to read this report 3 separate times. And if you follow me on Instagram at Fireside Chat, I posted on Insta story. It's like this is a weird, very, very weird unemployment situation summary. Okay. I had to read this 3 separate times because I couldn't believe how bad the report was. Total non-farm payroll employment came in at 12,000 jobs versus 100,000 jobs expected. I'll say this again. The expectation from Dow Jones was 100,000, and the report came in with 12,000 jobs. And that's absolutely insane. What's even more insane was that the unemployment rate remained at 4.1%. And they made all of us scratch our heads thinking why it was still 4.1%, right? But, nevertheless, the unemployment rate at 4.1% is still considered healthy in the eyes of the government. But if you read the bottom of the paragraph here, where it talks about hurricanes, Helene and Milton, it basically says that it is not possible to quantify the net effect of those two hurricanes on the jobs total. The Bureau also said that average hourly earnings increased by 0.4% for the month, which was higher than the estimate. And the average work week held steady at 34.3 hours. So depending on who or how you read this, you could easily blame the weak labor data due to the strikes at Boeing and the two hurricanes. But, it is certainly not trending in the right direction, in my opinion, based on what I read. Okay. So let me pull this up here from CNBC, and you can read where all the jobs went in the month of October. Healthcare and social assistance had another large gain at 51,000 jobs, with the government sector at 40,000. And if you want to know what some of the big recession indicators are, it's industrial production, non-farm employment, and retail sales. Okay. And there's been a negative trend in the retail trade, and that primarily focuses on companies that sell goods and services to consumers. Leisure and hospitality is another sector that we all want to pay attention to, and it's down 4,000 jobs just in the month of October. So if you cancel out healthcare and social assistance, government sector, manufacturing, and professional and business services, that's about a net gain of 4,900 jobs in these job sectors. And maybe the November report will be different, but again, this is not trending in the right direction at all. And this is more of a reason for the Fed to cut interest rates today and in December, just based on labor, right? Now, one thing that is also making us all scratch our heads is the US GDP. So gross domestic product increased at a 2.8% annualized rate for the advanced estimate. So there are three estimates for the GDP. We have the first estimate or the advanced estimate, and then we have the second estimate that's coming out on November 27th, and then we have the final revised third estimate on December 19th. And consumer spending and federal government outlays continue to be the biggest contributors to our GDP growth. And this is all while the interest rates are still high. So consumer spending accounts for 2/3 of the GDP, right? You also have to account for the relentless government spending in the GDP, and it's costing the budget deficit of more than 1.8 trillion in the fiscal year 24. And there are people in the comment section saying that we are in a recession. You can say that certain sectors, like manufacturing sector, has been in a recession for a while, but not the economy as a whole. A recession is a period of economic decline that lasts more than 2 consecutive quarters. So if we had a negative 1% GDP in Q3 and a negative 1.5% GDP in Q4, then that's technically a recession. And I know some of you guys would disagree with me in the comment section, and that's okay, but we don't change the definition of a recession just because we feel like it, right? That's what the previous administration did. And I'm not trying to criticize, and I'm not trying to say that I'm leaning on one side or the other, just telling you the facts, right? And let's get into the PCE inflation. The latest PCE inflation came out last week on Halloween, and it showed a 0.2% increase for the month. With the 12-month inflation at 2.1%. The core PCE inflation came out at 2.7% after the measure increased 0.3% on a monthly basis. Inflation increased just slightly for the month of September, but it's still on track to meet the 2% annual rate. And we haven't seen this inflation rate since February 2021. And a lot of people are still worried about flare-up in inflation, which is understandable given the rate cuts in September, today, and December. What this data doesn't show is that some prices of essential goods and services still haven't come down, and insurance rates are still sky high, and some grocery items are still at a 3-year high. And we're essentially paying for items at the price that should not be happening until much later at the 2027 or 2028 prices adjusted for inflation. And if you don't know what the PCE price index is, it is the personal consumption expenditure price index that measures the prices that people pay for goods and services. While CPI, on the other hand, or consumer price index, measures more items that are not included in the PCE inflation. And that's why CPI tends to show more inflation than the PCE. Okay. So if you're especially looking to borrow money in 2025 because you're buying a house, starting a business, or expanding your business, I strongly encourage you to mark your calendar or make sure to get your notifications by subscribing to this channel or joining my private community at firesidechat.com/community. And we're also going to have President-elect Trump inaugurated on January 20th. And we could also see the very last of Jerome Powell for the FOMC meeting on December 18th, which will also come out with another version of the SCP that will give us a better idea of what the Fed will do in 2025. But anyway, we're going to have the next inflation data or consumer price index twice on November 13th and December 11th before the next meeting. And we're also going to have the producer price index twice on November 14th and December 12th. And retail sales report, they'll come out on November 15th and December 17th. And those are going to be interesting with the holiday shopping season. And we're going to have the second estimate of the Q3 GDP next week on November 27th to find out if we're going to see any changes of 2.8% from the first estimate. And on the same day, we're going to get the PCE inflation, which is something the Fed pays attention to. And unemployment is what we'll all pay attention to on December 6th. And we're also going to get the JOLTS on December 3rd. And if you're just now tuning in, it stands for the Jobs Openings and Labor Turnover Survey, which helps gauge labor demand, while the unemployment rate measures the supply side of the labor market. The JOLTS report will give us a better indicator of a solid or weak labor market, right? Last but not least, the final Federal Reserve meeting of the year is on December 18th. We're also going to get the latest summary of economic projections, or SCP, that will give us a better outlook of what the board members and presidents, bank presidents, are thinking of doing with interest rates in 2025. And we got about 4 minutes left. And this is the SCP, or the summary of economic projections from the September FOMC meeting. We're not going to get a new one until December 18th, right? And they come out every quarter in March, June, September, and December. For the Fed funds rates in 2024, the range changed from 4.9% to 5.4% to 4.1 to 4.9%. It's definitely given them more room to do 2 more rate cuts of 25 basis points. So if they cut 25 points today and another 25 points in December, the Fed funds rates will be at 4.25 to 4.5%. But the other possibility is that they drop it by 50 basis points in December, and that could put the funds rate at 4 to 4.25%, which is still in the target projection range by the Federal Reserve board members and bank presidents. For 2025, it's a wide range for 2.9 to 4.1%. The median Fed funds rate is 3.4%. So we could see another 150 basis point rate cut by the end of 2025. Now, President-elect Trump could push to cut the rates faster and more because he already said during this campaign that he wants to have a say in interest rates. And no one is really sure how that even plays out since the Federal Reserve is politically independent. This is also one of the questions I would expect the reporter to ask, and that's how the members of the Federal Open Market Committee will start discussing how Trump's economic policies could affect consumers. If there's inflationary pressure due to the tariffs Trump imposed, is the Fed going to raise interest rates? We didn't see any significant inflation increase when Trump imposed tariffs in his first term back in 2018. But the difference this time is that we're just now recovering from high inflation from the Biden administration. And Trump's proposal to impose tariffs is not just on China, but for the rest of the world. And how is this going to affect the GDP in 2025? The SCP is projecting a median of 2% GDP in 2025, or anywhere between 1.3 and 2.5%. And this is where the Trump administration has to be prepared for, and that is the retaliation from countries like China. If he imposes 50 or 60%, 100% tariffs, the tariff revenue could fall if other countries retaliate by imposing their own tariffs on the US. So in the short term, we could see the level of consumer prices rise while the level of US real GDP decreases. Can it pay off in the long term? I honestly don't know, but I know that this is one of the first things Trump will do in the first 100 days of his office. But we're gonna get ready to find out what the Fed is gonna say. But in the meantime, you can go to firesidechat.com/resources to get your free 401k calculator, financial independence calculator. You can schedule a consultation with me at firesidechat.com/consultation here. So let me go ahead and show Bloomberg with the sound on.
Out there right now.
With the exception of maybe gold, which is what we've seen so far this year.
Yes.
Massive run. Massive run.
Come on. That
Record high on election night.
That was the big winner, right? So maybe that's the new reserve currency. That's what we were going to be, right?
That's what we saw.
Capital?
Yeah, apparently. Kathy, it's good to see you. As always, Kathy Jones there of Charles Schwab. Bob Michael's going to stick with us through the decision. Just to set up the scores for you with about 90 seconds to go, and we'll start with equities after a historic run in this equity market. All-time highs on the S&P 500 this week, record highs on the NASDAQ 100 this week, moves we haven't seen on the Russell in several years, a move of almost 6% following the election in the United States of America. In the bond market, I think we should stress once again, Lisa, this is a very different bond market to the one on September 18th when the Federal Reserve reduced interest rates by 50 basis points. The 2-year had a 3 handle. The 10-year was trading in the 360s. We are 70 basis points higher since then.
And it came before the election. And that's what people are pointing to, the fact that we are seeing just an incredible upside surprise to a whole host of economic features here. I do wonder, though, how they frame that increase that you've seen in the long end at a time where they are talking about balanced risk.
Okay,
and
here we
ongoing
go. It should be coming out now.
The data surprise to the upside.
Yes.
It's not just the politics.
Correct.
The 50 basis point cuts, some people believe, encourage the move in long end rates as well. Do they understand their responsibility in some of the moves we've seen?
Which is the reason why some people think that you are going to get another descent from this rate decision. Potentially could be, again,
0.25%.
8-1.
10 seconds to go. Apparently, this is an easy decision.
I'm ahead of
for
you,
the Federal
Bloomberg.
Reserve.
It's
And the Federal Reserve
0.25%
decision
they're going
we're
to
looking
cut.
for
And
is an interest rate cut on the FOMC of about 25 basis points. With that decision,
4.5 to
Mike McKee.
4.75%.
You got it, John. A quarter-point cut in the Fed's benchmark interest rate, a few changes to the statement, and that's about it from the Fed. The target range now 4.5 to 4.75%. There is no change to balance sheet policy. The decision this time unanimous, as September dissenter Mickey Bowman voted for this rate cut. Inflation, the statement says, has made progress, dropping the word further toward the 2% target, but remains somewhat elevated. No longer included the assertion that the committee has gained greater confidence that inflation is moving sustainably toward 2%. The economic assessment suggests a slightly weaker labor market, noting that since earlier this year, labor market conditions have generally eased and the unemployment rate has moved up, but remains low. Still, the statement repeats September's view that risks to achieving its employment and inflation goals are roughly in balance. The rate cut today is in support of its goals instead of September's in light of the progress on inflation and the balance of risks. Policymakers note again they will consider additional adjustments to their benchmark rate, but offer no further guidance beyond that. There is no mention of politics in the statement. That will be up to Chairman Powell in about a half hour.
And Mike McKee, it'll be up to you, sir, to ask the questions. How many questions do you expect are going to be leading with the events of this week and not this decision?
Yes,
How
good
much of this is
questions,
going to be
too.
about the politics at 2:30, Mike?
I would imagine quite a bit would be, and maybe we want to check the Las Vegas over-under line for that. But he's not going to say anything. He's not going to respond. So the question is, how many different ways can we ask, and how many different ways will he parry the question?
60 minutes of that. Looking forward to it. Michael McKee, you've got to run. I know that news conference begins in about 28 minutes' time. So no big changes to the statement. 25 basis point rate cut as expected. And when you see something like that, you're not looking for a big change in the market either. We stay higher on the S&P 500 by about 0.6%. Yields are still a little bit lower. On a 10-year, we're still down by 8 basis points, 435. And in foreign exchange, the euro gives up a little bit of the move, but still positive on the session. Lisa, 107.84 on euro dollar.
I think it's interesting that the Federal Reserve removed a reference to gaining confidence in inflation and saying that labor market conditions have generally eased. Honestly, to me, you're looking at this and on the margins, just setting the stage to potentially be a little less dovish. And that is the tone that I really am curious to hear in the press conference.
With us around the table, Bob Michael of JP Morgan, and a man who's seen it all before, the former Fed Vice Chair, Rich Clarida. Rich, I want to start with you, and not on the 25 basis point rate cut. You lift the tariffs of Trump in Volume 1 on the Federal Reserve. How did you handle it then? How much scenario analysis did you do ahead of time? How do you think this chairman's going to handle it in the months to come?
Well, the staff did good work, and some of that's in the public domain now, comes out every 5 years. The reality is, during my time at the Fed, inflation was running a little bit below target. The tariffs that were put in place made the headlines, but they didn't really push up inflation very much. You know, the devil will be in the details, I think, both on trade policy and fiscal policy. And I don't think they need to make any big decisions at this meeting or the next meeting about how they'll strategize for 2025.
Vice Chairman, I want to go to the politics of the moment. We're not going to get an answer from Jerome Powell, so we're going to get it from you right now. Harry Truman, 1950, before William McChesney Martin saved the day. I quote, President Truman, I hope the board will not allow the bottom to drop out from under securities. If that happens, that is exactly what Mr. Stalin wants. We've had this pressure before, and you and your brethren are going to get the pressure this time from President-elect Trump. How does the Fed deal with it?
I think they deal with it, Tom, the way that they did the last time, is just stick your, keep your focus on the goals of policy, price stability, maximum employment, and do what you think can best achieve those goals. You know, as you point out, opinions on the Fed, including from presidents, are not unheard of, and so we could see more of that. But I think the Powell Fed will just keep doing what they're doing.
How much is the market, though, speaking louder than any policy that's going to come down the pike? The fact that we've seen this massive rally in stocks and a sell-off in bonds that hasn't really hit risk assets. How much does that have to really cause the Fed to pause and even reconsider whether to cut rates again in December?
Good point. You know, I do think financial conditions are obviously an input to policy, but I would hope the Fed does not convey the impression that they're too sensitive to financial conditions, because they can rise and fall for a number of reasons. My own sense of what we're seeing this week is some of it is not so much more stimulus down the road as more certainty that the existing 2017 tax bill is going to be extended, right? So it's the absence of a tax hike as opposed to necessarily a tax cut. Yeah. And I do think the deregulation piece of this is also important. So we've certainly seen a level set. I wouldn't necessarily extrapolate this from here. We'll just have to see how this plays out.
Either way, what we've heard is just the deficit.
Yeah, so some of the stocks that I'm definitely paying attention to, and I never talk about cryptocurrencies, but based on their campaign and all the speeches that I listen to, and yeah, I listen to all the speeches and I follow everything politically. I just don't really talk about them on this channel. because I want to focus on finances. But I might need, I'm gonna have to start paying attention to Bitcoin, because if they do push Bitcoin to become one of the central bank assets. So right now they don't have any Bitcoin in their mixed assets, right? But if they do push it to put Bitcoin in there, that's going to be a game changer. People who have been investing in Bitcoin for a long time, that's going to be a huge win for those guys. I have like very little crypto personally, not financial advice by any means, but it's just one of those things that I'm going to be paying attention to. The other one is social media companies. So if you have let's say Meta, Snap, and I do wonder if the Republican-controlled Congress will impose any restrictions on the social media companies. I don't think they're going to break them up, but they could potentially have more oversight over them, and how that's going to affect the social media company stocks to be determined. But I think that's something that's worth paying attention to. The other one that I'm looking at is Russell 2000. So the small cap stocks, as you guys saw, it took off. They took off yesterday, right? That's about what, 5%. A lot of the small cap stocks were up like 20%, 30% in one day. I think the investors are realizing that some of the tax cuts are going to benefit the small cap companies more. Not so much on the large companies, but more on the small cap companies. And you guys know that the small cap has been underperforming for many, many years. And I'm looking at just Russell 2000 with a 5% increase, and year to date return has already hit 20%. So if you guys follow the guy Tom Lee, he comes on CNBC a lot, and he talked about a 50% increase on small cap stocks in 2024. I don't think that's going to happen. I mean, it's 20%. But if he has said it in 2025, I could see that as a possibility. So investors are kind of more like, wow, what Wall Street really likes is there's a, let's say, Republican president, and then there's a divided Congress, right? So to them, it means that nothing will change. But now we have a Republican-controlled Congress, and pretty close on the House, and now we have a president-elect Trump in the White House. They see this as more like, whoa, we're going to have more deregulations in Wall Street. We're going to have more deregulation in the banking industry. We're going to have more easy money, probably quantitative easing coming up. QE, right? If they print more money, that's a possibility. So, if people have been investing consistently, it's it's good news for them. But people who are just starting out, that's good news too. That now is a good time to get into the stock market and start investing. You should always buy. Don't buy and sell based on who gets elected. I've never done that. I've always been buying, no matter who gets elected. The other one that I do want to pay attention to, let's see, energy stocks. I want to see how that plays out with the potential oil pipeline coming back into the fold. And I think Trump already said that, what was the slogan? They said, drill, baby, drill, right? So I think they're going to start producing more energy to export to other countries, and that could be a potential revenue increase for federal spending. The other thing was bringing down the cost of energy, so that's something that I do want to pay attention to. Bringing down the cost of energy, just looking at the gasoline prices, that's what everyday Americans pay attention to, is, wow, how is this going to give me more room in my budget to spend more money on other things? But when gas prices were up and grocery prices are high, they don't have any room to do discretionary spending. So that's why economists back then in 2022, they were like, well, here's a little bit of a recession because inflation went way high, and we're paying a lot of money for just on groceries, gas, rent, and you got nothing, and insurance, right? And you have no room, nothing else in your budget to spend anything else. So I believe, this is just my personal opinion, and I'm not by any means taking sides on any political party, but when people voted, I believe people are looking at, well, my economic situation was far better during the Trump administration than I was during the Biden administration. So when Kamala Harris ran on her campaign, people looked at her and say, well, is this going to be a continuance of the Biden administration because she was the vice president of the United States? No, she still is. Sorry, she still is the VP. So I think a lot of voters kind of thought of that and say, well, do I want the continuance of Biden administration, but now with Kamala Harris, or do I want what I had back in 2017 to 2020 and under Trump, when my stock market, the stock market was up, my prices were low. Do I want that? And I think, people in the swing states really spoke when the election was decided right on Tuesday night. So let me know in the live chat what your thoughts are, based on how the election unfolded. And I know someone else in the comment section last week said that this election is not even going to be close. This is going to be a landslide. Man, if I can remember who that was, I got to give that person props on that. Just quickly, I'm gonna see if they're saying anything else useful on there. Sometimes they just kind of start talking about nonsense.
Is a problem, and also insurance costs. Those are more structural in nature. But at the end of the day, it's the Fed's job, one way or the other, to get enough prices to fall to get to that price stability, but to get inflation to no longer be number one issue. I think that's going to be more challenging as we get into 2026. I agree wholeheartedly that the bulk of the policy shifts that we see, especially in terms of fiscal policy, are not likely to hit till 2026. And I don't expect a lot more than the extension of the tax cuts that we had, with maybe some additional corporate tax cuts, but we will see. And I think it will take some time. I don't think it's all going to be done in the first 100 days. The tariffs, as Rich said, are issues that can be a level change, but if you combine them with curbs on immigration at this time and actually have any kind of deportations along with that, that tends to both stem growth and stoke inflation in this environment. We are not where we were pre-pandemic, and certainly tariffs in sequential order along with retaliatory tariffs, that kind of a situation would be much harder for the Federal Reserve to deal with, and the pressure on the Fed is going to intensify if that occurs.
There's a lot of nodding around the table. I find it fascinating how little we understand inflation and exactly what's going to cause a real surge in it. And I do have to wonder, and Bob, I'll throw this to you because I know you think that the Fed should keep cutting and that there is weakness to be addressing. I am struck by the fact that there hasn't been a more market slowdown in any of the economic data with high yields, with rates at the long end as high as they've gotten. Doesn't that tell us something about how restrictive or not that restrictive policy actually is at this level?
Well, I think it's unfair to say there are no signs of a slowdown. As I said, you look at new and existing home sales. Those are purely dependent on the level of rates currently, because we know home prices aren't going to come back and they're quite high. And so new and existing home sales are down. They're going to decline further with this pop up in rates. And as I said, in corporate America, you look at the amount of...
I agree with him. So just real quick, the housing market is it's like stagnant, right? You have sellers who have plenty of time and just sit on the sideline. They put it on the market and like, well, I got a lot of equity in this home, and I'm not in a rush to sell it, right? But you have buyers who are frustrated because the 10-year Treasury yield keeps going up and the home prices keep going up because the inventory is low. So imagine this, right? You have a 2.8%, a 30-year fixed interest rate. Why would you want to move to another house that is going to cost you 6.5% in interest rate? Unless you have a sizable down payment to match the monthly payment. What I always recommend is no more than 25% of your income towards your mortgage payment. But most people don't want to do that because of the mortgage rates, right? So if you take a look at it, I'm going to go ahead and share this screen just real quick. Let's see. Jerome Powell is going to speak in about 15 minutes, and I'll make sure to turn into that, when it comes out. But yeah, this is what they're talking about. So the mortgage rate keeps going up. I mean, the Treasury yield for 6 straight weeks keep going up even after your election is over. So the average 30-year fixed rate mortgage rose to 6.79%, up from 6.72% a week earlier. The average 15-year fixed rate mortgage was essentially unchanged to 6% to 5.99%. So yeah, what I'm trying to get at is I know we talk about the Fed funds rates a lot, but mortgage rates typically follow the 10-year Treasury yield. So I think what people are concerned about is President-elect Trump's inflationary policies with tariffs and cutting taxes. That's giving American people more money, and that's making people want to put their money on the sideline more. So I don't think we're gonna see a decrease in mortgage rates probably until like January or maybe February. Is my best guess, because if I show you the housing data here, let me see if I can show this. Oh, there we go. Yeah, the housing market as of September 2024, the median sale price is $427,000. So that a little bit of decrease from its high at $442,000 in June, and the prices keeps going down. But if you look at the supply side here, the supply side says you have a consistent, and it looks pretty consistent actually. You got a 1.8 million homes sold, and then you have a little bit of decrease going into September, but it's not a whole lot though. So it's been kind of like going up and down from 2022 at the lowest level when the interest rates were at sky high. But the demand has gone down. This is where it's really interesting going into it. So let me go to the 1-year chart here. So this is from Redfin, if you want to take a look at it. So looks like the homes sold demand-wise above listing price is negative 4.7 points. So let me go and home prices with prices drop. Okay, so they're selling more. They're buying more homes with the prices drop. So if I list my home for like, let's say 30 days later, and I drop my price from, I don't know, 400,000 to 390,000, and then that's how people are like, well, I can save $10,000 to pocket that to pay more on the mortgage payment, whatever, or pay less on the mortgage payment. That's it looks like that's what people are doing here. Let's see. Do you want to look at, let's see, who was I talking to the other day? I want to look at Las Vegas because this is where I'm at right now. And I am looking to sell my house. That's right. Looking to sell my house starting today. So, but I'm the seller that I am in no rush to sell it because I have plenty of equity from the home that I bought back in 2014, right? So the median sale price in Vegas is $450,000. Good Lord, man. It just keeps going up. Well, that's good news for the sellers, but not necessarily good news for the buyers. Number of homes sold, what the heck? Decreased to 700 homes sold year over year. Wow, that's really interesting. And only 39 median days on the market too. Wow. Okay. Nevada, one of the swing states. I believe this is more leaning on Trump now. The reason why, and I think the news media covered this pretty good. If you look at all the maps with the highest inflationary impact, they voted for Trump. And cities historically blue, they always went to blue, red always went to red. But if you look at all the swing states with counties that have people have voted that are more like swing states, Vegas was one of the places they got hit pretty hard with inflation, especially the unaffordable housing market. They have gone to red. And I know that Vegas, if you look at it here, it shows blue, but they didn't lose by much. It was a very, very close margin. So let me zoom out here. I do want to take a look. Hang on. How's the Senate doing? Senate, I think, is still, yeah, that's a close one too. Looks like the Senate, and then we have the House. Okay, so how do I go back out to the House? Show all the states. There we go. So yeah, wow, 210 House seats. So they don't have a whole lot to go to gain it. I'm pretty sure they just haven't called them, but it looks like the Republicans will have the majority in the House, and they already have the majority in the Senate with 52 seats. And if Nevada, Jackie Rosen versus Sam Brown, if Sam Brown does win for the Republicans, then GOP will have 53 Senate seats. So that'll be very interesting. How, this is going to be a very easy presidency for Trump, because he can just go to the Capitol, like, hey, we should pass this, and then they say, yeah, let's do it. I'm just kidding, but it's something like that. I'd imagine that's what they'll do. Okay, I do want to look at the rate cuts in December, and it looks like they're probably going to cut it by another 25 basis points. That's a 63% chance. In January, they're looking at another 25 basis point rate cut, but they have a 28% chance now. And then March, yeah, it looks like we're still going to be in the 4% federal funds rates by March. So we'll see what happens. Yeah, this is going to be really, really interesting. Let me see here. Look at Bloomberg. I'm going to pull up CNBC as well.
Inflationary outcome where it makes it difficult to disentangle what's happening from a demand side versus a supply side story.
Jerome Powell should be speaking in about 5 minutes, so let me go and pull him up too.
Look through the tariff effects on inflation, but I think that they were probably just less prone to do so for a few reasons. One, inflation is already above their target and is continuing to do so. Two, inflation expectations could be at risk of moving higher, and I think that this is primarily, or even more so, an issue if those tariffs are phased in over time. It makes it more difficult and complicated, I think, to identify the price level shock, and makes you a little bit more worried about it factoring into inflation expectations.
So, Bob Michael, if I want to affect the Luzetti-Claire to move here in bonds, price up, yield down, how far out on duration do I want to be into 2025? Do I want to extend duration?
Yeah, I think you do here. I think there are a lot of things to do. That's the kind of interest we're seeing from clients. The municipal bond market is a large part of that. A lot of clients who own municipal bonds have ladders. Stuff is rolling off. Roll it out to 10 years. There's a lot going on in credit. Get out there and invest. You have to recognize there's been a pretty significant backup in.
Wow, Bitcoin last week was 67,000. Now it's sitting at about 76,000. Wow.
Year or so.
There's some people, Bob, worried about a buyer strike emerging in the bond market. And I just wonder, with yields at these levels, do we just keep sucking capital away from the rest of the world here in the United States? Because if I'm thinking about the policy coming down the pike, from my perspective and many others as well, if you're investing in America, there's going to be policies to reward it. If you're exporting it, that's a very, very different scenario, trying to export into America. But do we just keep sucking capital away from the rest of the world?
Well, yesterday was the perfect evidence of that. There was every reason to hide from the bond market. You had a 30-year auction, and it went flawlessly.
Yeah.
You see the same thing, Rich?
I do. And in particular, look, we focus on the U.S., but it's a global bond market, and Treasury yields 4.5. We saw almost exactly a year ago, Treasury yields got to 5, and there was a voracious appetite to lock in those yields. And so I do think there's a range within which the growth in the Fed and the fiscal pit plays in. But beyond a certain point, it becomes very attractive to international investors.
So we retain the privilege of acting recklessly, as some people might say. Maybe.
Absolutely.
Kicking that can down the road.
Yeah, although I do wonder what the consequence is of kicking the can down the road and then Germany saying, hey, they're doing it, so we'll do it too. This sounds like a good plan. France, hey, what about us? And all of a sudden you get yields rising higher. And how much does the bond market suck in the capital away from other risk assets? That's the question. No, I'm serious. That's one of my main questions.
Some of these European bond markets have learned they're not American.
Yeah, okay. All right. So let me just go over this one thing. The S&P 500 is getting it might hit 6,000 by tomorrow, possibly if everything goes well. So let me look at it's at 5,609 5,965 right now. That is something. When people ask very frequently, should I even start investing now or should I wait for the next market crash? Dude, just keep investing. If it's for your retirement and you have a 20-year time horizon, where do you think the S&P 500 is going to be 20 years from now? And we're looking at 5 years ago. It was when? It was 3,000 points on November 8th, 2019. Do you see that? Okay. Now we're at 5,965. That's a 92% gain in the last 5 years. So when people, what's crazy is that when the market has a correction, people just kind of like panic and say, nah, I don't want to buy anymore. Or they just say, I'm going to wait until the market dips more and then I'll buy more. Like, why not just always buy? Always just dollar cost average, no matter what the market does. If you look at the maximum, right? I started truly investing around here. Let's see, right around here at about 2,000 points. I don't know how else to say it, but if you're just real quick, if you're a TSP investor, that's Thrift Savings Plan, that's the federal government version of the 401k. I do have a live stream coming up tomorrow. So tomorrow at 9 a.m. Pacific Standard Time and 12 p.m. Eastern Standard Time, that's going to be a free webinar. And I do this for Veterans Day. I'm a veteran. If you're brand new to my channel, I am an Air Force veteran, so I do help as many people in the military as possible, or people who retired from the military or federal employees with the TSP investing. If you go to firestatechair.com/resources, you can get this for free. It's a TSP price tracker. You just go on a Google sheet and it's always going to be updated every day because TSP does a terrible job updating what the prices are. Sometimes they just kind of like only show the rate of return from 3 months ago, and they don't update that all the time. And if you look at it, C Fund has a 25% return already, and that's as of yesterday. And the market is up by, what's today? The market is up by 0.64%. So I would imagine this is going to go up to 26% return when it gets updated tonight or maybe tomorrow morning. Here's what's really interesting. Look at SCAP. Man, look at SCAP. SCAP, or I'm sorry, SCAP, S Fund, small cap stock index fund. It's returned 20%. It's definitely beating out the I Fund, right? So I Fund at 8%. You can forget about F and G funds there, but CS and I funds, all together, you made a tremendous return this year if you invested this year. You made a tremendous return if you invested last year. So please don't time the market. Be in the market and stay in it. Okay. Let me pull up Jerome Powell here. Okay, here we go.
How are you?
Let me see if I can just go to Bloomberg. Should be coming out now. A little delayed, so you know what? I'm going to switch over to Bloomberg. Sorry about that, guys. A little delay. Yeah.
employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has eased substantially from a peak of 7% to 2.1% as of September. We are committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the FOMC decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by a 1/4 percentage point. We continue to be confident that with an appropriate recalibration of our policy stance, strength in the economy and the labor market can be maintained, with inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 104,000 per month over the past 3 months. This figure would have been somewhat higher were it not for the effects of labor strikes and hurricanes on employment in October. Regarding the hurricanes, let me extend our sympathies to all the families, businesses, and communities who have been harmed by these devastating storms. The unemployment rate is notably higher than it was a year ago, but it has edged down over the past 3 months and remains low at 4.1% in October. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly over the past 2 years. Total PCE prices rose 2.1% over the 12 months ending in September, excluding the volatile food and energy categories. Core PCE prices rose 2.7%. Overall, inflation has moved much closer to our 2% longer run goal, but core inflation remains somewhat elevated. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we're attentive to the risks to both sides of our mandate. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 4.5% to 4.75%. This further recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we move toward a more neutral stance over time. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing policy restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. We are not on any preset course. We will continue to make our decisions meeting by meeting. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation is not sustainably moving toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can move more quickly. policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Here we go. Questions?
Thank you.
About the
Given
election.
the expectation that the election outcome will produce policies that would meaningfully impact the U.S. economy next year, how is the committee taking these proposals into account for upcoming decisions, including potentially the next one in December? And can you give us any more sense of how proactive or reactive the Fed is prepared to be to changes in economic policies with the next administration?
Sure. So let me say that in the near term, the election will have no effects on our policy decisions. As you know, many things affect the economy, and anyone who writes down forecasts in their job will tell you that the economy is quite difficult to forecast looking out past the very near term. Here, we don't know what the timing and substance of any policy changes will be. We therefore don't know what the effects on the economy would be, specifically whether and to what extent those policies would matter for the achievement of our goal variables, maximum employment and price stability. We don't guess, we don't speculate, and we don't assume. Now, just in principle, it's possible that any administration's policies or policies put in place by Congress could have economic effects that over time that would matter for our pursuit of our dual mandate goals. So we, along with countless other factors, forecasts of those economic effects would be included in our models of the economy and would be taken into account through that channel.
Nick.
Chair Powell, Nick Timrose from the Wall Street Journal. Roughly
I like
1 year
him.
ago, when the 10-year Treasury was flirting with 5% and 30-year mortgage rates were near 8%, you noted how higher borrowing costs, if they were sustained, could weigh on economic activity. Given that you've said you believe policy is restrictive and the Fed is now dialing back that restriction, are the growth risks presented by higher U.S. Treasury yields today any different from those you identified 1 year ago when inflation was still meaningfully above your target?
So I would just say this: we've watched the run up in bond rates, and it's nowhere near where it was, of course, a year ago. I guess the long bond rates are well below that level. So we're watching that. Things have been moving around, and we'll see where they settle. I think it's too early to really say where they settle. Ultimately, I'm sure we've all read these decompositions of what, and I certainly have, but it's not really our job to provide our specific decomposition. I will say, though, that it appears that the moves are not principally about higher inflation expectations. They're really about a sense of more likelihood of stronger growth and perhaps less in the way of downside risks. So that's what they're about. We do take financial conditions into account if they're persistent and if they're material. Then we'll certainly take them into account in our policy. But I would say we're not at that stage right now. It's just something that we're watching. And again, these things don't really have mainly to do with Fed policy, but to do with other factors in the economy.
If I could follow up, is the September SEP, are those rate projections still valid? Do they still seem relevant given where we are now?
You get halfway through the cycle between the last set and the next set. I wouldn't want to comment one way or the other. Let's talk about the data we've gotten since the last meeting. So in the main, the economic activity data have been stronger than expected. The NIPA revision was stronger. Certainly the September employment report was stronger. The October report, not stronger. Retail sales stronger. So overall, though, I think you take away a sense of some of the downside risks to economic activity having been diminished with the NIPA revisions in particular. And so overall feeling good about economic activity. So I think we would factor that in. At the same time, We got one inflation report, which it wasn't terrible, but it was a little higher than expected. So I think really the question is December, and by December we'll have more data. I guess one more employment report, two more inflation reports, and lots of other data, and we'll make a decision as we get to December.
Gina Smilik from the New York Times. Thanks for taking our questions, Chair Powell. When it comes to December, what will you be looking at specifically as you try to make that decision? And then as of the Fed's economic projections in September, you had written down 4 quarter-point interest rate cuts in 2025. Do you still think that those are likely? Is that sort of the baseline outlook at this point, or has that shifted? And if it shifted at all, can you give a little bit of detail as to why?
I can't. We don't fill out an SEP, and I can't characterize one that wasn't filled out today. So I can't really speak for kind of exactly where the committee is. I will just say for December, we're going to be, again, at every meeting, we're going to be looking at the incoming data and how that affects the outlook. As you know, we're in the process of recalibrating from a fairly restrictive level at 5.33%. After today's move, we're down 75 basis points. And we're asking ourselves, is that where we need to be? That we're trying to steer between the risk of moving too quickly and perhaps undermining our progress on inflation, or moving too slowly and allowing the labor market to weaken too much. We're trying to be on a middle path where we can maintain the strength in the labor market while also enabling further progress on inflation. We think that's where we are, but that's the question we're going to be asking in September. And in other meetings. And again, I can't really update you on the committee's thinking because we don't fill out an SEP at this meeting.
Yeah, totally appreciate that. I guess when it comes to your own thinking, do you think that a full percentage point of rate cuts in 2025 is a reasonable outlook?
Again, I'm going to wait. We're going to wait and see how things come in December. I mean, it's just. I would put it this way: we're on a path to a more neutral stance. And that's very much what we're on. That has not changed at all since September. We're just going to have to see where the data lead us. We have, a whole 6 weeks of data to look at to make that decision in December. Obviously, I'm not ruling it out or in, but I would say, I would say that, again, we didn't update the SEP, so I'm not going to characterize, where the committee would be.
Howard.
Thanks, Howard Schneider with Reuters. I wondered if you could please elaborate, explain a little bit the 2 changes in the language of the statement here. In the first paragraph, when you say inflation has made progress, dropping the word further progress. And in the second paragraph, dropping the sentence that the committee had gained greater confidence that inflation was progressing towards its 2% goal. Is there any policy substance behind either of those changes in language? Is it meant to open the door to a December pause? Is it meant to communicate anything about the stickiness of core inflation in the last 3 months?
Not really, no. So let me tell you what we were thinking. So the test of gaining further confidence was our test for the first rate cut, right? And so we met that test in September, and therefore we take that test out. If you leave it in, then it's new forward guidance. It's brand new forward guidance. What do you mean by it? Are you requiring yet further? We have to say yes or no at every meeting whether we've made further progress. The point is we have gained confidence that we're on a sustainable path down to 2%. So that I would tell you is what that's really all about. It's not meant to send a signal. Neither of those is meant to send a further signal. And saying further progress, it becomes a test where we don't want to be. We don't think it's a good time to be doing a lot of forward guidance. There's a fair amount of uncertainty in what I've said. The path that we're on, we do know where the destination is, but we don't know the right pace, and we don't know exactly where the destination is. So the point is to find the right pace and the right destination as we go. And I think there's a fair amount of uncertainty about that. And you don't want to tie yourself up with guidance. You want to be able to make sensible decisions as you go.
Steve
Leisman, CNBC. Mr. Chairman, you talked about higher rates, perhaps from an expectation of higher growth. You didn't talk about it in terms of expectations of higher deficits. Is that something you think might be behind the recent rise in interest rates? And is that are rising deficits a concern to you?
So we don't comment on fiscal policy. And again, I don't have a lot more to say on what's driving bond yields. In terms of policy changes, though, let me give you a sense of how this works in the ordinary case. Let's say Congress is considering a rewrite of the tax laws. Doesn't matter what's in the content. So we would follow that. At a certain point, we'd think we see the outlines. So we'd start to model it. And then we'd wait. And then at a certain point, the staff would brief the FOMC and say, you know, these are the likely effects. There's lots and lots of literature on the effects of tax policy changes on various parts of the economy. So we'd try to get smart on that. And then the law actually passes. And, you know, you'd start to put it, you probably run an alternative simulation before that happens, just to keep people trying to understand it. Then when it actually passes, it goes into the model along with a million other things. So, you know, we have a very large economy. Many things are affecting it at any given time. And, you know, a law change of some kind would go in there, but it would, you know, it's a process that takes some time. Clearly, the legislative process takes a lot of time. And of course, the real question is not the effect of that law. It's all of the policy changes that are happening. What's the net effect? And, you know, the overall effect on the economy at any given time. So I think that's a process that takes a lot of time and that we go through all the time with every administration constantly. And this will be no different. But, you know, right now there's nothing to model right now. It's such an early stage. We don't know what the policies are. And once we know what they are, we won't have a sense of, you know, when they'll be implemented or all those sorts of things. So I think I would just say we're not doing that now, and all that will take time, and it will be very much regular order when we do that.
If I could just follow up on Nick's question, are the current rates something you feel like you need to lean against in that they go against the direction of policy by adding restriction to the economy, or do you just take them as a given and perhaps a signal that you should do less?
I just think the first question is how long will they be sustained? If you remember the 5% 10-year, people were drawing massively important conclusions, only to find, you know, 3 weeks later the 10-year was 50 basis points lower. So, you know, it's material changes in financial conditions that last, that are persistent, that really matter, and we don't know that about these. What we've seen so far, you know, we're watching it, we're reading, you know, we're doing the decompositions and reading others, but right now it's not a major factor in how we're thinking about things.
Chris.
Thank you, Chris Rugaber at Associated Press. You mentioned the positive economic data that we've seen since the September meeting, including the revisions to things like savings, higher GDP growth. We saw stock market jump yesterday. That's renewed some of the questions about why do many cuts at all in this with this backdrop.
So you're right. As I mentioned, and as you mentioned, the latest economic data have been strong, and that's, of course, a great thing and highly welcome. But of course, our mandate is maximum employment and price stability. And we think that even with today's cut, policy is still restrictive. We understand it's not possible to say precisely how restrictive, but we feel that it is still restrictive. And if you look at our goal variables, the labor market has cooled a great deal from its overheated state of 2 years ago and is now essentially in balance. It is continuing to cool, albeit at a modest rate. And we don't need further cooling, we don't think, to achieve our inflation mandate. So that's the labor market. Inflation has moved down a great deal from its highs of 2 years ago. And we judged, as I mentioned, that it's on a sustainable path back to 2%. So the job's not done on inflation. But if you look at those two things, we judged in September that it was appropriate to begin to recalibrate our policy stance to reflect this progress. And today's decision is really another step in that process. Overall, as I mentioned, we believe that with an appropriate recalibration of our policy stance, we can maintain strength in the labor market, even as our policy stance enables further progress toward our inflation goal.
Great. And just to follow up, what might cause you to pause rate cuts in December? What kind of economic data would lead you to that?
Good question right here.
Thank you.
Finally.
So we haven't made any decision like that at all. But we're in the process, as I mentioned, of moving policy down, our stance down over time to more neutral level. And as a general matter, as we move ahead, we are prepared to adjust our assessments of the appropriate pace and destination as the outlook evolves. So, for example, if we were to see the labor market deteriorating, we'd be prepared to move more quickly. Alternatively, as we approach levels that are plausibly neutral or close to neutral, it may turn out to be appropriate to slow the pace at which we're dialing back restriction. Again, haven't made any decisions about that, but that's certainly a possibility. If you can think of it as similar to what we do with asset purchase, with asset runoff, with QT. So we reach a point where we slow the pace, much like an airplane reaching the airport slows down. And so we're thinking about it that way, but it's something that we're just beginning to think about.
Edward. Thanks, Chair Powell. So with the noise in the jobs reports that we've seen, and you look at the Fed's favorite inflation, PCE inflation, overall it's 2.1%, very close to the Fed's target, but core inflation is 2.7%, and it's been that way since July. So why doesn't this data give fuel to a rate pause for this meeting?
Well, so I think if you look at the 3 and 6 month, you're quoting the 12 month. So yes, we look at all of them, right? But yes, if you look at 3 and 6 month core PCE, you'll see they're around 2.3%. So we look at all of them, and we also look at 12 as well. But what it's telling us is that we really have made significant progress, and we expect there to be bumps. For example, the last 3 months of last year, the core PCE readings were very, very low, probably unsustainably low. So that's why you.
This is what he's talking about. Just real quick. Yeah. So some of the data that they're looking for is the CPI for these dates, right? And then looking for the PPI, retail sales, PC inflation for the November 27, and then unemployment and jolts. So I just wanted to point that out.
One is the non-housing services and goods, which together make up 80% of the core PCE index, are back to the levels they were at the last time we had sustained 2% inflation, which happens to be in the early 2000s for a period of 5, 6, 7 years. So they're back to that level. What's not is housing services. So let's talk about housing services. Housing services is higher. What's going on there is, market rents, newly signed leases are experiencing very low inflation. And what's happening is older, leases that are turning over are taking several years to catch up to where market leases are, market rent leases are. So that's just a catch-up problem. It's not really reflecting current inflationary pressures. It's reflecting past inflationary pressures. So that's one thing. The other thing is I'd say look at the labor market, not a source of inflationary pressures. Where's it coming from? It's not a very tight economy. What is the story about inflation? You see that catch-up inflation also in insurance and several other areas. So you're seeing we're not declaring victory, obviously, but we feel like the story is very consistent with inflation continuing to come down on a bumpy path over the next couple of years and settling around 2%. That story is intact, and it won't be 1 or 2 really good data months or bad data months aren't going to really change the pattern at this point now that we're this far into the process.
So you're quickly trying to get to that neutral rate that you see, or do you foresee that you have some time to get there?
Nothing in the economic data suggests that the committee has any need to be in a hurry to get there. We are seeing strong economic activity. We are seeing ongoing strength in the labor market. We're watching that carefully, but we do see maintaining strength there. And so we think that the right way to find neutral, if you will, is carefully, patiently. Again, that's not meant to have a specific meaning, other than to the extent the economy remains strong, we have the ability to take advantage of that as we try to navigate that middle path between the two risks.
Craig.
Hi, Chair Powell. Craig Torres from Bloomberg. 2 questions today. Did you learn anything about what Americans think about the economy from the election results? First question. Second question. I want to talk about some labor market indicators, and I do so with great respect for your attentiveness to the maximum employment side of the mandate, Chair Powell. So the unemployment rate has been at 4% or higher for 6 months. One of the broadest measures of unemployment is up about 0.5 point from a year ago. Compensation gains are sliding back. The quits rate, a signal of labor market dynamism, has been heading down to that bad neighborhood of the 20 teens. So you have put a marker at Jackson Hole saying any further cooling is unwelcome. It is cooling generally a little bit further. So at what point do we reach what you would describe as a shortfall from maximum employment? Thank you.
Sure. So on your first question, I'm not going to talk about anything that relates directly or indirectly to the election. On the second one, this is the great question, and it's the one we think about all the time. So I'll just say a couple things. There's nothing really surprising here. What we know is that the unemployment rate is low. We also know that it's moved up significantly from a year or so ago. So we've seen a big change upward in unemployment. Sometimes that has meant bad things. So far, it doesn't appear to be. It appears that I wouldn't say that the labor market has fully stabilized, because I do think it's continuing to very gradually cool, but it seems to be in a good place. And our policy, of course, is designed to keep it in that good place, to maintain the strength in the labor market while also enabling further progress on inflation. You mentioned a bunch of indicators, and you're right. The openings to unemployment rate is back to a normal level. I would characterize it more broadly as normalizing. You mentioned wages. Wages are still running just a bit above where they would need to be consistent with 2% inflation, unless productivity is going to remain at this high level. If we see productivity, more sustainably at these high levels, then that would sustain higher wage gains. So I would say, in fact, you can say it the other way, that wage increases are now consistent with 2% inflation given current productivity readings. But of course, the lore on productivity readings is whenever you see high readings, you should assume they're going to revert pretty quickly to the longer term trend. That has always been the case for 50 years. But it may be that we're now 5 years. If you look at the NIPA revisions that came out a month ago, we're 5 years into a nice set of productivity readings, which are sustained and very healthy. But overall, it's a good labor market. We could talk about 20 different data series. We'll be looking at all of them, of course. We don't want the labor market to soften much from here. We don't think we need that to happen to get inflation back to 2%.
Victoria. Hi, Victoria Guido with Politico. Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
Mike?
Oh,
Mike
man.
Ritchie from Bloomberg Radio and Television. You
Was
talk
waiting
a
for
lot about what the data are telling you and how you are dependent on the data. But in terms of forward-looking assessments of the economy, what are you hearing from CEOs or other officials around the country? What did you hear today from the regional bank presidents about what companies and consumers think about where the economy is going from here rather than looking backwards? And does that match up with what your forecasts have been and what you think the appropriate policy path should be?
So it's hard to characterize a really interesting set of discussions we had, and of course you'll see them in the minutes in 3 weeks. But I would say this: I think the comments from our Reserve Bank colleagues and from the CEOs that they talk to are pretty constructive on the economy right now. Pretty constructive, feeling that the labor market is back to normal, to the point where it's no longer that much a discussion topic in their worlds, whereas 2 years ago it was all they were talking about. So they feel like the labor market's in balance. people feel good about where the economy is. Demand is obviously pretty strong. And you're seeing 2.8% growth in the third quarter estimated. Maybe the year's 2.5%. This is a strong economy. It's actually remarkable how well the U.S. economy has been performing with strong growth, a strong labor market, inflation coming down. We're really performing better than any of our global peers, and I think that is reflected in what you hear from what I hear people hear from CEOs. I don't get to talk to a lot of CEOs in my job, but I hear what others summarize from those. And of course, I hear the Reserve Bank presidents do a lot of that. And it's pretty constructive overall. Now, that's not to say there are areas of caution and things like that, but ultimately, overall, pretty positive.
Well, to follow up the areas of caution, if there were black clouds on the horizon that you identified as something you're watching, what would they be?
I think it's things like clearly geopolitical risks around the world are elevated. And just as clearly, they've had relatively little effect on the U.S. economy. Now, that can change through the price of oil or otherwise, but people talk about those as something that's on the horizon all the time. But ultimately, if you look at the U.S. economy, its performance has been very good, and that's what we hear from business people, and expectation that will continue. If anything, people feel next year, I've heard this from several people, that next year could even be stronger than this year.
Andrew.
Hi, it's Andrew Ackerman with the Washington Post. I just wanted to follow up on the discussion earlier on fiscal policy. Your predecessors, Greenspan and Volcker, spoke up loudly when they thought large budget deficits endangered economic or financial stability. Will you do that too? And right now we're in a period of full employment. We have large budget deficits and debt at historic highs that are rising. Is that something you'd speak out against?
So, I have said many times, no more, no less than what the predecessors you mentioned have said. And what that is that the U.S. federal government's fiscal policy is on an unsustainable path. The level of our debt relative to the economy is not unsustainable. The path is unsustainable. And we see that in, you've got a very large deficit you're at full employment, and that's expected to continue. So it's important that we, that to be dealt with. It is ultimately a threat to the economy. Now, I can say that. I don't have oversight. We don't have oversight over fiscal policy. I've said it on many occasions, just said it again.
Okay, thank you. I guess the other question is to follow up on Victoria's question. Do you believe the president has the power to fire or demote you, and has the Fed determined the legality of a president demoting at will any of the other governors with leadership positions?
Not permitted under the law.
Not what?
Not permitted under the law.
Thank you.
Courtney.
Jerome Powell's like,
from Axios.
Can't fire me.
In response to Howard's question, you said it wasn't an ideal time to give forward guidance because of the economic uncertainties. Can you lay out what some of those uncertainties are and whether or not it includes some of the proposals that the president-elect has put out on the campaign trail? Tariffs, for instance?
No, I was not referring to the new administration's policies at all, nor will I today. So what I'm just saying is, as we look ahead, we know, and I mentioned this in my statement, that the risks are two-sided. I guess I should start by saying that we think that the economy and we think our policy are both in a very good place, And but as you look forward, you say, what are the risks? And one risk is that we would move too quickly and find ourselves having moved too quickly, and inflation comes back, and we lost our chance to get inflation back to 2%. So we have to avoid that risk. And to avoid that risk, that means you want to move carefully. The other risk is that we move too slowly, and that we allow the labor market to weaken too much and do unnecessary damage to the labor market and to people's working lives. That says don't get behind the curve. So these two things are the two risks that we have to manage. And so we're in the middle there. We try to be in the middle and deal with both of the, manage both of those. Again, the idea is to support the strength we have in the labor market and in the economy, but also with somewhat less restrictive but still restrictive policy, enable further progress toward our 2% inflation goal. This is a thing we're meeting by meeting, we're going to be making our assessment of what the right path is. It's not as important. The precise timing of these things is not as important as the overall arc of them. And the arc of them is to move from where we are now to a sense of a more neutral policy. We don't know exactly where that is. We only know it by its works. We're pretty sure it's below where we are now. But as we move further, there will be more uncertainty about where that is. And we're going to move carefully as this goes on so that, we can increase the chances that we will get it right.
Simon.
Thank you, Chair Powell. Simon Rabinovich with The Economist. I know you don't want to share your decomposition of bond yields, but if you look at the break-evens, it is clear that longer-term inflation expectations do seem to have risen up at about 2.5%, for example, on the 5-year. That's up half a point from when you cut in September. Do you have any concern at all that longer-term inflation expectations are de-anchoring, or put another way, are anchoring at a slightly higher level? Thanks.
So we would be concerned if we thought we saw longer-term inflation expectations anchoring at a higher level. That's not what we're seeing. We're still seeing, between surveys and market readings, broadly consistent with. I looked at the 5-year earlier today, and it's probably moved, but it's just not. It's kind of right where it's been, and also it's pretty close to consistent with 2% PCE inflation. So that's one that's been a traditional one that we look at a lot. But overall, expectations seem to be and really have throughout this in a place that's consistent with 2% inflation. But you're right to say we watch that very carefully, and we will not allow inflation expectations to drift upward. But that's really why we reacted so sharply back in 2022 was to avoid that.
Kelly.
Hi, Chair Powell. Kelly O'Grady, CBS News. We just talked about what you've heard from business leaders on the economy, but many average Americans are still not feeling the strength of the economy in their wallets. So what's your message to them on when they might expect relief?
So you're right that we say the economy is performing well, and it is, but we also know that people are still feeling the effects of high prices, for example. And the world went through a global inflation shock, and inflation went up everywhere, and it stays with you because the price level doesn't come back down. So what that takes is it takes some years of real wage gains for people to feel better. And that's what we're trying to create. And I think we're well on the road to creating that. Inflation has come way down. The economy is still strong here. Wages are moving up, but at a sustainable level. So it's just, I think what needs to happen is happening, and for the most part has happened. But it'll be some time before people, regain their confidence and feel that. And we don't tell people how to feel about the economy. We completely respect what they're feeling. Those feelings are true. They're accurate. We don't question them. We respect them.
And just a quick follow-up, President-elect Trump has been critical of your performance. Any concern about his influence on the Fed's independence?
I'm not going to get into any of the political things here today, but thank you.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genser with Marketplace. What is your plan if we start to see stagflation?
Well, so that's the whole plan is not to have stagflation, so we don't have to deal with it. So that is actually our plan. It's of course a very difficult thing because anything you do with interest rates will hurt one side or the other, either the inflation mandate or the employment mandate. I would just say that we've been able to see inflation come down a whole lot, much closer to our goal, without the kind of sharp increase in unemployment that has often accompanied programs of disinflation. So knock on wood, we've gotten this far without seeing a real weakening in the labor market. And we believe we can complete the inflation task while also keeping the labor market strong. And that, of course, is exactly what we're trying to do.
Can you rule out an interest rate hike next year?
No, I wouldn't rule anything out or in that far away, but that's certainly not our plan. I mean, our baseline expectation is that we'll continue to move gradually down towards neutral, that the economy will continue to grow at a healthy clip, and that the labor market will remain strong. If you look at our that will not change from the September SEP. That is our baseline forecast, and short of some exogenous event, that will continue to be our forecast for the foreseeable future. So, but ultimately, we're not in a world where we can afford to rule things out a full year in advance. There's just too much uncertainty in what we do.
Let's go to Jean for the last question.
Last question.
Hi, Chair Powell. Jean Young with MNI Market News. I wanted to go back to a comment that you had made about Americans being quite unhappy about the cumulative price level rises over the past few years, even though now inflation is back on a path to 2%. Would it be appropriate for the Fed to undershoot for a while on its inflation goal under the average inflation targeting regime so people have a chance to catch up?
No, that's not the way our framework works. We're aiming for inflation at 2%. We did not think it would be appropriate to deliberately undershoot. And part of the problem there is that low inflation can be a problem too, in a way. But that's not part of our framework, and it's not something we're going to be looking at in our framework review. Thank you very much.
Okay, so
An
can the
absolutely
president
news news conference with
fire
Chairman
Federal Reserve Chairman? So I found rather more smart people who wrote this, and I'm gonna share this with you just quickly. Can the president of the United States fire the chairman of the Federal Reserve? This is from Brookings Institute. So let me scroll down here. Can the president fire Powell? So he holds 3 positions, and I'm just kind of learning about, I forgot about this too. I learned about it a while ago, but he's a member of the Board of Governors appointed by the president and confirmed by the Senate. Chair of the Board of Governors, separately appointed by the president and confirmed by the Senate, and chair of the FOMC by vote of the members of that committee. So, the interest rate decision, it's not going to be all, let me fix that. Okay. It's not going to be all, Jerome Powell's decision to cut interest rates or raise interest rates. It's not just him. There's a board of governors, they vote on it. And then, the dots that I showed you in the SEP summary of economic projections, that's where it comes from, right? So to remove a member of the board of governors, the president has to have a reason, a cause, to quote the statute, a term that courts have historically interpreted as requiring inefficiency, neglect of duty, or malfeasance in office. Policy differences are probably not enough justification, but the Supreme Court could ultimately decide that question differently. If it did, that would represent one of the biggest changes in administrative law in the United States in 80 years, so don't count on it. Now, this was written in 2019. Things are changed. We have the conservative majority Supreme Court. We have the Senate we have the Republican Senate, and then now we are on the brinks of that the Republicans taking over the House. So that's going to be all different because Congress can change the law and say, yep, now the president can, have a say in the what the Federal Reserve is going to do. They can change the law and say the Federal Reserve is no longer an independent agency, right? It's not just the president himself can change the law. It takes an act of Congress to do that. So that's going to be really interesting. So the statute says nothing, however, about whether the president can fire the board chair, effectively demoting him to being just one of the other governors. Presidents have concluded that they lack that authority, and there's good reason to think they were right, but we just don't know. It's legally uncertain. interesting. So, the president could say, I'm going to fire this guy. And Jerome Powell can say, no, like he said during the press conference, he's like, no, he's not legally allowed to, right? So what happens if Trump tries to remove Powell as board chair? He couldn't, Jerome Powell can make things simple by just resigning his governorship and just go quietly into the night, like this says. Or he could go loud and just sue to get legal clarity on his status. Powell's lawsuit would be a very important one. Courts cannot hear just any conflict. The plaintiff in the case must have standing to sue the defendant. Yep. All right. So the many would-be plaintiffs who have tried to sue to challenge the Fed's governance structure in the past have all been batted down because they didn't have the right kind of grievance that could be addressed at the right time by the court's decision. So, Trump saying that he disagrees with what the Federal Reserve is doing is not going to be enough justification to remove Jerome Powell as the chair of the Fed governors. What I'm reading so far. Let's see. You can read this. You can just type in Google. If I can find it, you can find it too. Yes. So yeah, this is another thing is if the president, so if Trump says, I need you to get off the chair as the Federal Reserve, he could say, all right, fine. I don't want to be a chairman anymore, but Powell can still stay on as one of the board members in the Fed. So, and then they can just, the vice chairman will be the person taking over for Jerome Powell to speak at the press conference. He's really kind of like the representative, right, as for the Federal Reserve. And, he's leading the board members, but he is not the only decision maker. That's one thing that a lot of people don't realize how it works behind the scenes. And, just the way that Jerome Powell reacted to the question, the first one, it was just hilarious. He just said, no. But anyway, this will be really, really interesting if when inauguration day is on January 20th. And if, Trump says, I need you to get out, I need you to be gone, then we'll see what happens. I doubt that it's going to happen. I really doubt it. That's just my personal opinion. It would be crazy if he did, though, But anyway, I appreciate all of you guys being here. Tomorrow, I'm going to have the live stream about the TSP Thrift Savings Plan free webinar. That's going to be a fundraiser for the USO for veterans serving overseas and their families who have to stay home for the holidays. So if you want to come out and support, even if you don't have a TSP, you can come out and support watching that live stream. All the YouTube AdSense, all those dollars are going to be going straight to the USO. Even if you don't watch the live stream, you can watch the replay at like a 1.25 or 1.5x speed, and those dollars will still go to the USO. I'm not going to get any dollars for it. I don't get a tax write-off, none of that, okay? I'm a veteran, so I love to support our veterans. But anyway, until tomorrow, 9 a.m. Pacific Standard Time and 12 p.m. Eastern Standard Time, I will be live for the TSP tomorrow. So, but anyway, until then, see you tomorrow.